How to make money in markets. Why trading is a painful and low probability success business. 1. Does not contribute anything in society. 2. One cuts one's profits quickly because of fear of losing whatever one is gaining. 3. One does not cut losses early and let them increase in the hope of recovery because cutting losses is a painful as well as admission of failure process, and one does not like to experience pain of failure and it is painful to admit failure. 4. The forces that determine profit or loss are beyond one's control besides being very powerful relatively. Hence high stress leading to quick burnout. 5. Revenge trade or taking bigger risks to recover losses leading to bigger losses. 6. The attention remains hooked to trade setup because you want to control anything the moment the market goes against one's setup, hence extremely stressful, and one cannot do any other task. 7. One cannot bet big for fear of losing, hence the profits are likely to be small only. Perhaps nature punishes traders for that because only 1% of retail traders make money. Source NSE. Based on above reason, only very lucky few can make money. Most of the people will make huge losses. However, what are the antidotes and attitudes to manage these challenges of trading? 1. Use the money earned for doing something of value to society. Ultimately, it is the money that makes the world go around. 2. Make the process robust so that one can reap full benefits, if possible. This seems difficult to overcome. 3. Use strict stop-loss even if it means losing money. 4. Become used to these forces. Sometimes they will help and sometimes they will go against, but on balance they will help if your intentions are noble. Have realistic expectations and think in terms of probability. 5. Be very aware of the desire for revenge trade and hence discipline yourself to stay away from it. Wait of right opportunities to come your way. Do you have enough EQ to manage this? Raise your EQ before becoming a trader. Have the humility to accept defeat and learn from this feeling of pain rather than being an egoist who wants to take revenge. 6. This is the price you have to pay in terms of time and disturbance of peace. You cannot do any other activity well while you are in trade. You are likely to be driven to control all the forces that may go against you. Maybe EQ will help to let go of this compulsive behavior. 7. You can bet big only when you are very clear that trade is going for you, otherwise be happy with small income only. Chances of making big money are less compared to investing. Trading is a mechanism in which wealth is transferred from low EQ people to high EQ people, and market is a dynamic almighty God which does this. Why direct investing is tough. 1. To acquire KSA for investing in stocks requires minimum 5 years of dedicated study and then further 5 years of full-time practice to be able to do real justice to the investment work to get good return. Is it right? 2. To select a stock for investment demands minimum 4 weeks of study, both of company and industry. Then one has to keep following all the news and quarterly results, both of which are time-consuming. If one sincerely does this, then one cannot do any other activity. 3. Despite doing above, the investment environment is not in one's control at all, and hence luck plays a great role there, such as at what time one enters the market. Based on above, the probability of making money by retail investor is very low. Then what is the solution? Invest in mutual funds. How to select the same? Make a good judgment checklist of competencies of the fund manager. Only 10% of fund managers are really capable. Select the funds operated by these managers. If you have skill in selling far OTM calls and puts of index like Nifty and Bank Nifty etc., one may be able to add about 5% per annum in addition to mutual fund return, taking one's return to about 20 to 22% in the long run. Which is what you can aim by direct investment, provided you are lucky. Competencies, technical and behavioral, required in fund managers. Technical competencies. 1. Vision. to see what sectors are likely to grow in coming years and select companies in the sector based on criteria given elsewhere here. 2. Competency to judge business, scalable, opportunity size, enduring, durable competitive strengths, and low disruption chances. High ROAS, good returns on net tangible assets, customers love their products. Internal funds-based growth possibilities, sensible purchase price. 3. Ability to judge the management and be a strength. The management of the selected companies should have execution skills based on past track record, low dilution of equity, low DE, low debtors receivables, great capital allocation skills, focus and lack of unnecessary diversification, low salary and perks. 4. Abilities to take action when required for buying stocks companies based on above assessments. This requires behavioral competencies mentioned below. 5. Skill to understand the value and price of business. The likely psychological competencies required will be the following. 1. Taking responsibility. 2. Courage and risk-taking appetite to go against the general trend and perceptions. 3. Risk-taking, hence EQ, to manage the balance between fear of failure versus hope of success. 4. EQ, to take back feedback and learn, or in other words learning skill of the highest order, no compromise on this learning skill. 5. Multidimensional interests to understand future and have a good vision. 6. Win-win attitude and ethical makeup. 7. Self-discipline to study and work hard. 8. Self-awareness because style of investing is linked to personality, judgmental versus perceptive.